What's going on, guys? MMuniz here, and today we got a banger of a video. My father and I go back and forth about the best places to put our money and how to handle certain situations. Recently, we came up with an interesting conversation. I decided to put the pen to paper, well, actually my fingers to keyboard because I love Excel, and I wanted to test some things that most people don't really talk about when it comes to this fund in particular. Now, I'm pretty excited about the results and I can't wait to show you guys. So in today's video, we're going to talk about QYLD and the risks associated with this tricky investment. Now, QYLD has some diehard fans, an entire Reddit group dedicated to investors, some pretty strong haters, people on YouTube that absolutely love QYLD. However, at the end of the day, do the risks of this investment overcome the known benefits? So everyone talks about the high monthly yield of around 1% per month, which is 12% annualized from the covered calls, but does that return allow you to overlook the major risk of capital decay that we've been seeing? We're down about 13% over the past year, and since its inception about 8 years ago, we're down 20%. Well, to answer this, we need to first figure out what is the major risk associated with the capital decay that we've seen over time. Well, obviously, if our investment goes to zero, if QYLD goes to zero, which can happen, and all of a sudden we can't access our money, that's a problem. That's a major risk. For instance, maybe you lost your job and you need the money that day. That would be an example. Well, we're going to be a little bit more descriptive on that. So for my dad and I, the debate was specifically about how much cash do you need to have on hand? You know, in a high yield savings account like Ally, for instance. Is it a year's worth of expenses? Is it 6 months worth of expenses? Is it $1,000 cash? Which of those options versus dumping a significant portion of your cash into something like QYLD to hold money there for those situations? Now, I've talked about this in the past, and at first I thought the best way to handle this would be having a blend of something like NUSI and QYLD or QRMI and QYLD, something that's able to take advantage of protective puts to protect that money. However, I do have a video in the description below. It's about NUSI, why I don't believe that those are actually good options. And the only reason for that is just because it only protects you in a massive crash versus what we're in now, which is just kind of a slow decay over time. We're not crashing 20% or 30% in 1 week. We're losing a couple percent here or there every week, which in the long run is adding up to significant losses. If we look at the current standings of the QQQ versus 1 year ago, we're down 7%. If we look at VUG, VUG, which is my personal favorite growth ETF, it's down 8.5%. QYLD itself is down 13%. Now remember, that doesn't take into account dividends, which obviously changes the story, but we'll talk about that. So what am I going to show you in this video? Well, I have 3 specific scenarios where we're going to look at the entire history since inception of QYLD. We realized that it's been around for about 8 years, and in those 8 years, there's been many ups and downs. So if you had taken your money and taken it out of a high yield savings account, put it into QYLD, and face some of the market fluctuations, what would happen? Well, we have the option 1 where we just keep our money there, we reinvest dividends, we don't ever touch it. We never had something pop up where we needed it. It's just holding cash. Option 2, we put our money into it and we wanted to spend the cash. This is for someone that's maybe retired or someone that's, wants to use the passive income, which is fine. It's not my favorite, but that's option 2. And then option 3 is something different that I haven't covered before and I think is really interesting. What if we lost our job 4 years into our investment and we needed to take some of our money out of that investment? What would happen? How would we do? Is it actually better than if we had kept the money in a savings account? Well, to be more specific, we also need to realize that if something like that were to happen, you wouldn't immediately liquidate all of your entire savings or your entire investment. You would take out what you need to pay your monthly bills. So we're going to look at a specific example of that, and I think it's pretty awesome. So that emergency scenario is how much money would you take out per month in order to survive, and what would happen to your portfolio over time. Now, before we get into the video, I do need to describe that I am not a financial advisor, and this video is not financial advice. It's up to you guys to do your own research and determine what's the best move for you and your family when it comes to setting yourself up for success. However, if you work hard for your money and you want to make it go further, make sure you smash the like button down below, subscribe to the channel. I do weekly videos on anything related to personal finance or fitness. So let's get into the video. So a quick rundown of QYLD, because I'm not going to do a super in-depth explanation. There's plenty of videos on YouTube already. There's plenty of videos in my history that explain it. We have a covered call ETF that buys stocks from the NASDAQ 100, and then it writes monthly covered calls in order to generate returns, premiums that cause those returns on a monthly basis that they then give to their investors. The average return is around 1% a month or 12% annualized. So pretty good return. However, price has gone down over time, and that's what we're going to look at in the first example. So in the first example, we're going to just say we invested $10,000. We had $15,000 cash, and we said, you know what? I'm not making any money in our savings account. Let's put some of this into the market and see what happens. Well, we put it into QYLD back at its inception when it was $25 a share. This is a lot more than it is today, which is less than $20 a share. At the end of this, our investment would still be $17,700. And if we were to compare that to a savings account that returned an average of 1.3%, we would have had $11,000. So that'd be 8 years. And the reason I chose 1.3% is I do know that about 5 years ago or even 3 years ago, returns were a lot higher in high yield savings accounts. Now they're around 0.5%, but I just tried to make a little bit higher than what we're seeing today to make this more realistic. But let's go back to the first example because I want to point something else out. In this example, we are reinvesting dividends. You can see here we started with 400 shares. We reinvested and we ended up with 404 shares after getting paid the $100 dividend. We continue to grow our shares over time. And as you see, our dividend continues to increase over time as well. When we look at the price did go down. We started at 25 bucks and it's gone down and it continues to go down. But our ending result for total cash is still $17,700. Now I do know that this does not include taxes. So if you feel we need to look at taxes real quick, we could do that. Let's go ahead and click on some NerdWallet and look at our tax brackets. We have single filers, and if you're like me, married filing separately. Well, if you make $100,000 a year, which this is going to be my tax bracket, we are at 24%. So you would have to take away a portion of those monthly returns, and yes, you would have to pay taxes, but it's going to vary based on your personal situation. There is a chance that it would be return of capital, but that is not guaranteed, so we're not going to talk about that. At the end of the day, you do take on some risk, but if we just choose any random time here to pick out 12 months, let's go ahead and pick out 12 months. If I had invested back on the 15th, my initial investment, 11.1, would have turned into 11.4. If I do another random one, we'll do 15.7 down to, we'll go 12 months again, 18,195. Now there is going to be times when it does go down, yes, but that's just how the market works. There's going to be some risk involved. However, since we are gaining 12% a year, if you're holding for a year, the likelihood that the market's going to drop 12% or higher is pretty low. It does happen, yes, but it's pretty low. So you're minimizing the amount of loss because you're collecting those premiums. If you have a massive recession and a terrible bear market, then yes, you are going to lose money. But when we compare that to something like just holding QQQ, technically you would have done better in QYLD because you're still gaining back some of the premiums from the covered calls. Now let's look at our second example here. Now our second example here, we do not reinvest dividends because we are spending all of our dividends. So this is going to be an example for someone that has participated in FIRE, financial independence, retire early, or maybe they're a bit older and they have retired and they decided to take some of their savings and put it into QYLD. However, they did not want to reinvest dividends. They wanted to use the cash, which is completely fine. That's technically what this fund is for. We see our portfolio value starts at $10,000, and yes, it does decrease. With the price of QYLD going down, we are going to see price decay. It is down 20%, so would your original investment. You would have ended up with $700, $800. However, if we look at your dividends that started off 170, 80, typically around the 80s, end up still being around the 80s. Now, past results don't guarantee future results, but it's not like we're seeing a significant drop-off in dividends that coincide with the price. When we look at our actual dividends per share, I have a graph here that shows, if anything, it stays about flat, but actually over time it actually increases. We did have a few months where there wasn't a dividend, and that's what's skewing the result. But we also had a month where we had a super high dividend, which was at the end of 2021. So in general, over the past 8 years, it would not have been a bad investment to move cash into this and just take advantage of the dividends. It's completely okay. Now this one here, this one's going to be very similar to the first one, except we come into a big problem. 4 years into our investing and reinvesting, we lost our job. We need to take money out. Now, just like we wouldn't do this in real life, we would not take out all the money at once. That wouldn't make any sense. But let's just say we need $2,000 a month to pay for our expenses, and we lost our job for 5 months. We ended up getting reemployed after that. Well, at the start of losing our job, our money was at just under $14,000. We pulled out $2,000 by selling shares. We sold 80 shares, and we ended up having 477 shares, which is actually still 77 more shares than we started with, versus the 558 of when we lost our job. We still got a dividend payment, and we decided, you know what, we already paid our bills for the month, so we're going to reinvest that, and now we're going to be at 482 shares. Well, we now have $12,000 left because we spent money and we lost shares. That makes sense. But we did the same thing again. We once again had less shares left because we sold 80, then we sold 84, 83. We continue to sell shares off on a monthly basis, but we're still making a dividend. We're still buying more shares. At the end of 5 months, on the 6th month, we actually got our job back, and we decided we're not going to pull out any more money. We're not going to sell any more shares. Well, we ended up getting down to just under $4,000. That's a significant amount. But if we took out $10,000 total, we still had $4,000 left, which is, if we compared that to the bank account, we would have almost nothing left. So with our QYLD investment, not only did we keep some of our original investment, but we're also making a monthly return even when we're taking money out to pay for our life. So all in all, yes, you could do that same scenario that we just went over at any point, maybe 7 years into your investment. Even if you had done it 1 year into your investment, you still would come out ahead. It would still be better than if you compared it to a high yield savings account. Now, there is a very small risk that it could go to zero or the dividends decrease and all of a sudden it's worthless, but I just don't see that happening. That's like the same risk as the S&P 500 going to zero. I guess, yes, it could happen. But at the end of the day, you could probably get higher returns if you invest in something like QQQ, for instance. Capital appreciation is going to be more beneficial than something that caps your growth, like QYLD, because of the covered calls. However, personally, I believe psychology of stocks matters. So even though it may be a mental accounting fallacy, where you believe that your dividends are netting you a higher return, on paper they're probably not, but it still may help you stay the course and it still may help you in your investing journey. The key is always to diversify. Have a portion of your money in there and then have your money split up elsewhere. We all know hindsight is 20/20. If we had the option, we could have put $10,000 in Tesla 5 years ago, sold it today, we'd be up a ton. That would be great. But with a fund like QYLD, you have a very consistent return, and that allows you to make decisions where should you use cash or should you put some money into an ETF like this. At the end of the day, it's up to you guys to decide, but my family made that decision. We still have some cash, but significantly less than what we would have held back in 2020. Is that the right option for you? Only you can decide. If you found today's video helpful, please make sure you hit the like button. Let me know down in the comments. Maybe you disagree entirely. You think QYLD's a horrible investment. That's fine. I'd love to hear it. Let me know. Take care.